I think if we do leave the EU, then one thing that multinationals would want to look at, I think, is the absence of the parent subsidiary directive, and in particular the imposition of withholding tax on dividends. The UK currently doesn't have a withholding tax on dividends paid by a UK company, but it is potentially subject to withholding tax on dividends received. And the parent subsidiary directive means that there is no withholding tax on dividends paid to a UK company by other member states in the EU. If that were to fall away, the companies would have to look back on the underlying double tax treaties, and not all of those have a zero weighted withholding tax. So there is potentially an issue for UK holding companies of EU subsidiaries.
If there is a leave vote, there is case law that has come out of the European Court of Justice, or Court of Justice of the European Union to give its proper name, which means that transfer pricing rules are required to be enacted so that they impact affiliates both within borders and cross borders within the EU. That jurisprudence wouldn't bind the UK if we were to leave the European Union. There are related matters to transfer pricing, like country by country reporting and the proposal on sharing of tax rulings, which again we wouldn't necessarily be bound by if we voted to leave the EU. I think state aid is a slightly separate issue. So when you talk about sort of investment in things like commodities, it's worth bearing in mind that there is some discussion at the moment about whether or not it is appropriate to use state aid as a vehicle through which you attack transfer pricing arrangements that have been made by member states. But regardless of the outcome of those discussions, if we were to leave the EU, we wouldn't necessarily be bound by EU state aid rules as they currently exist.
Something that businesses should be doing soon after a leave vote is looking to see what the impact of WTO tariffs would be on their entire supply chain as well as their exports. And then we expect government will be looking to industry to help advise on what should be government's priorities in terms of negotiating new FTAs. So only by looking at the impact of WTO tariffs on the current business will industry be able to do that. What we can say is when you have a system like VAT, which is implemented in the UK but is implemented pursuant to European directives, at the point the UK leaves, not much changes. But over time, legal systems change, they adapt. UK VAT will go one way, VAT in the EU is likely to go a slightly different way. So you could end up over time with two really quite different systems, and that will produce anomalies, complexities and costs for business.